Brad Williams, Frugal Finance, Portfolio Insurance. I chuckle because long ago it was the mainstream tool in Wall Street. Not so much today, but like I said, some of this information I have is dated. I thought I'd just present it to you, and you can make comments as to, well, that's a little dated, Brad. You said up front, this method might be dated. So let's take a look here. Portfolio insurance. Traders have a powerful set of tools at their disposal when it comes to changing the risk of their stock portfolio. Trading stock index futures. By engaging in this practice, one can customize the level of risk to suit their needs. Here's how it works. When you sell stock index futures for a well-diversified portfolio, you effectively create a combination of stocks and futures that carries less risk. On the flip side, if you hold on to your stock portfolio while buying stock index futures, you end up with a portfolio that's riskier, but also could offer significantly higher returns. Let's talk about portfolio insurance. This conversation revolves around a set of methods designed to manage the risk linked to a portfolio's asset. The main goal is to prevent the portfolio's value from dropping below a certain predetermined level while still allowing for upside growth. The main goal is to prevent the portfolio's value from dropping below predetermined price. Most portfolio insurance strategies rely heavily on stock options, but it's worth noting that stock index futures play an equally important role. When these strategies are executed using futures, it's referred to as dynamic hedging. While delving into the intricate mathematics behind dynamic hedging is beyond the scope of this discussion, it's clear that index futures serve as indispensable tools for safeguarding portfolios against potential downturn. As I said, we're looking at something that you may find it appealing, maybe not. Here's an example. We will look at a fully diversified portfolio worth $100 million. The value of the portfolio can range from zero to infinity. Many investors would like to put a floor beneath the value of the portfolio. For example, it would be very desirable to ensure that the portfolio value never falls below $90 million. Portfolio insurance offers a way to control the downside risk of a portfolio. However, in a financial market, there's no free lunch, so it's only possible to limit the risk of a large price fall, sacrificing some of the potential for gain. Portfolio insurance, similar to life insurance, certainly is not free, but it may be necessary for some trader. We have seen that a risk-minimizing hedge converts a stock portfolio into a synthetic T-bill. By fully hedging our example stock portfolio, we can keep the portfolio's value above $100 million. A fully hedged portfolio will increase in value at the risk-free rate, although full hedging eliminates all of the potential gain in the portfolio beyond the risk-free rate. With dynamic hedging, the trader holds the stock portfolio and sells specific future contracts. The more insurance protection trader wants, the more futures he or she will sell. Similar to the previous 5 sessions, but we're going to fine-tune it a little. Let's assume that a stock index future contract has underlying value of 100 million and a trader sells future contracts to cover 50 million of the value of the portfolio. In its original position, the trader is long 100 million and short 50 million in futures, so only 50% of the portfolio is hedged. Table 8.4 shows this initial position in the time zero row. At time t equals 0, there's been no gain or loss on either the stock or futures. In the first period, we assume that the value of the stock portfolio falls by 2 million. The 50 future contracts cover half that loss with a gain of $1 million. Therefore, at t equals 1, the combined stock future portfolio is worth $99 million. The manager increases the coverage in the futures market by selling 5 more contracts. This produces a total of 55 short positions and 56%, 55 divided by 99, coverage for the total portfolio. In the second period, the stock portfolio loses another 2 million, but with 55 futures contracts, the future gain is 55 divided by 99 times 2 million equals 1.11 million. This gives a total portfolio value of 98.11 million. Dollar cost averaging. By t equals 4, the stock portfolio has fallen 10 million, but the futures profit have been 6.2 million. This gives a total portfolio value 96.21 million. Also, the manager has increased the futures position in response to each drop in stock price at T equals 4. The trader is short 80 contracts, hedging 83% of the stock market portfolio. At T of 5, the stock price drops dramatically, losing 35.86 million. The future profit covers 30.65 million. This creates a combined total portfolio value of 90 million. However, this is the floor amount of the portfolio, so the trader must now move to a fully hedged position. If the stock portfolio is only partially hedged, the next drop in prices can take the value of the entire portfolio below the floor amount of 90 million. At 6, the prices of the stock drops 10 million, but the futures position fully covers the loss. Therefore, the combined portfolio maintains its floor value of 90 million. You see, this is rather cumbersome, and collectively, how much did the market drop? So I think it's probably a 30% drop, and I don't think that's even realistic. I'm not going to do the math, but Table 8.4 shows the basic strategy of portfolio insurance with dynamic hedging. Initially, the portfolio is partially hedged. If stock prices fall, the trader increases the portion of the portfolio that is insured. Had the stock portfolio risen in value, the futures position would have lost money. Still, the loss on the futures position is less than the gain on the stocks due to the fact that the portfolio is only partially hedged. As the stock price rises, the manager will have bought back the futures, thereby hedging less and less of the portfolio. What you're doing is telling the hedge. In short, they can call it hedging or dynamic hedging, but they're just manipulating the portfolio using portfolio insurance, taking a rather conservative approach. And there it is, portfolio insurance. Comment, would you do it or not? Brad Williams, Frugal Finance. Thanks for watching.